Hi, everybody. Thank you very much for joining in for Ambit 365 webinar for the month of September. And we are calling this webinar Buy the Dip Market, which is what the characteristic the market has been displaying so far. So before we actually go into the topic of the month, and also we talk about how the portfolio positioning is, which sectors we like, which sectors we do not like at this point of time, i.e., how is our book position in terms of longs and shorts. Just a 30-second overview on the product, the fund, and the key features. So just to reiterate, we are equities long-short fund, directional equities long-short fund. So we do take directional bets. The underlying instrument is by and large equities. We trade through futures. We don't do options. We don't do cash market. We do only futures. And our focus is to generate absolute consistent return irrespective of market direction. So whether the market direction is up, down, or sideways, we target to return, make absolute positive returns. The return that we guide is about 9 to 10% or 9 to 11% post-tax, post-fees returns on a 12-month rolling basis, which will to deliver 9 to 11% because we are a full tax product. We need to deliver about 17 to 20% or 17 to 19% gross returns. So after fees and taxes, this will work out about 9% to 10% or 9 to 11%. So that's what our guidance is. Because we are a directional equities long-short fund, in terms of return distribution, we also guide that do expect 2 or 3 down months from us in a 12-month period. Do expect 2 to 3 outlier months from us in a 12-month period. So when I say outlier months in which returns could be 3% or higher, and the balance 6 months would be average in the region of, for the want of a better range, let's say 1% to 2.5% or 1% or 3%. Because we do take directional bets, and hence, whenever the market goes through a bit of a rotation from one style to the other, or from one sector to the other, we could have 1 or 2 down months. By the time we realign to the changed cycles in the market, sometimes we do take a hit. So we are a slightly more high volatile product as compared to some of the other long short funds which would call themselves debt plus. So which is why we call ourselves debt plus plus. And to compensate for that slightly higher volatility, we also guide for a slightly higher return. So while most debt plus category long short funds would do 7 to 8% post-tax, post-fees, we guide 9 to 10 or 9 to 11. So 200 to 250 basis points higher, which obviously comes at the cost of a slightly higher volatility. I will not go into detail into the strategy of the product at this point, but just in one line, we manage the risk and the absolute returns by dividing the portfolio into 2 halves, stocks and Nifty futures. The allocation that we have kept is 100 for stocks and 80 for Nifty futures. Total gross exposure that we can take is 180. And the strategy that we follow in stocks and Nifty futures are uncorrelated and independent of each other, which is the key hallmark for managing risk in our product. We use a framework called the Sine Curve, which is our proprietary framework for stocks, which we will touch upon that when we discuss various sectors. So that's in a nutshell what the product positioning is. It's a debt plus plus product. We aim to make clear 400 to 500 basis points higher than risk-free on a post-tax basis, 200 to 250 basis points higher than debt plus products in the market. And that comes with a slightly higher volatility. Expect 2 to 3 down months from us in a year. In general, we'll try to reduce it going forward, but in general, that's the guidance. Sahil, can we roll next? So we launched on 6th October 23. So we will complete exact 12 months, I think next Friday or thereabouts, 4th or 5th of October 24. Last month for us was a down month, which was the third down month for us in the year, of which actually one down month was very small. It was just 10 or 15 basis points. Last month was sharp, minus 1.8%. This month is going well. We will come to that in a bit. So we will explain to you why the last month was down, why we got two down months within the last 3 months, very close to each other. The reason for that is approximately the same, and we have taken some corrective actions in terms of shift in strategy, a slight amount of shift in, not strategy, I would say, but a slight amount of shift in operating style or process. So, and that is already paying us good dividends in the month of September. So I will come to that. I will come to what went wrong in August. I'll come to how we have moved our style slightly, and how is it helping in September, and are we on track to meet our guided 9 to 10% post-tax, post-fees. So the key features I've already discussed, so we can move to the next slide, Sahil. So as I said, I mean, as this webinar itself is titled, it is basically a buy the dip market. It's become more of buy the dip market in the last few months. Every single dip is being bought into. The retail investors in India are feeling very confident, very bold. We are ignoring all risks, either it is domestic or foreign. For example, in the month of June, almost anybody, had we polled before the election results, what will happen to the market if BJP gets 240 seats? And the answer would have been a 15% down. It just fell for one day. Similarly, in August, the big yen scare which happened, market fell for one day and so on. So it is buy the dip market. The point to focus on this slide here is that the markets have been choppy right through this year, actually. In fact, it was choppier in the Jan to May period. Since June, while the markets have seen some drawdowns, if you see the chart of Nifty on the left-hand side, it seems more of a, if you zoom out a little bit, you see more of a runaway uptrend. Whereas if you see the rectangle, the part of the chart marked in the rectangle, this is Jan to May period where the markets were actually very choppy, up and down multiple times. But more importantly, during Jan to May period, whenever the markets fell, and I've got the details on the table on the right-hand side, whenever the markets fell, while the drawdown was only 3 to 5%, the fall actually took about 7 to 8 days time, every single instance, right? So when our systems triggered a short signal or a sell signal over Jan to May, on day 1 or day 2 of the fall, we had another 5 or 6 days to either book profits or to realign our position back to long if we found that the fall in the markets were substandard. And that worked really well for us. So during Jan to May volatility, we were up almost 10% in 5 months, averaging about 2% a month, despite a very volatile market and despite the fact that over Jan to May, total return by Nifty was only 2.6 or 2.7%. And in all those months, with the exception of 1 month, the short book delivered positive returns every single month. Because while the index dip itself was shallow, it at least gave us some time. It gave us some time to short book profits, rechange our position back towards long when the market turned up. However, in June and in August, the 2 months that we saw sharp negative months for us, if you see the table on the right-hand side and the rows which are marked in red, so while June drawdown was 8.8%, which is largest single drawdown year to date, but it took just one single day. The day the election results came out and the BJP numbers disappointed, markets started rallying from the next day onwards. In case of August, the drawdown of 4.7%, which is again at the upper end of the spectrum of a single of a drawdown within a month, exceeding January's 4.5 and even April's 4.3. When Bank of Japan, in a surprise move, raised interest rates by 15 basis points. On one single day, global markets stumbled. Nikkei was down 12%. That was the single largest fall for a single day in the global markets since 1987 Black Monday. So it exceeded, in terms of one single day fall, any single day fall during global financial crisis or during COVID times. And despite that, the total number of days consumed by Nifty for the fall was just 2 days. So it fell for 2 days and the market started rallying immediately after that. So in both these instances, in June and in August, when the sharp cuts happened, our systems triggered a short call, and we accordingly realigned our positions. We took aggressive short positions, we reduced our long positions, and we also shorted the Nifty. But the fact that unlike over Jan to May, we got no breathing space of another 4 or 5 or 6 days to either book profits or to realign our portfolio towards the long bias. The market started turning from the next day itself. And by the time stop losses got triggered on short position, by the time we got clear buy signal on our system, in both those months, the losses were fully baked in. So in both June and August, bulk of the losses that we reported during those months happened in the first 7 or 8 days of trading, in this 2-day dip, and then a gradual reversal after that. But if that's what the shape of the market is, if that's what the nature of the market is, it is our job to take the signals from the market. It's our job to keep on fine-tuning our systems. It is our job to keep on fine-tuning our process to fall in line or align with what the market trends are. So one big adjustment in our process that we have made so when June happened, we said it was a one-off. But when August happened again, we said it's happened twice, so it's not a one-off. And maybe that's what the current nature of the market is. The huge inflows coming into mutual funds, 38,000 crores last month. So long as that continues, perhaps the market will keep on doing this, just 3-day fall, 4-day fall, and reversal. So we need to fall in line rather than expect markets will fall in line. So one meaningful shift in the process that we have done, and we've written about that in our September newsletter also, which you must have received, is to say that we will adjust the book slowly over 3 or 4 days whenever we get a sell signal. So in September also, in the first week, we did get a sell trigger. We did short the Nifty, but we didn't change the texture of the stock book by any meaningful amount in that time period. And hence, when Nifty reversed, we just cut Nifty and we stayed out. And of late, we have started buying Nifty again. But the texture of the stock book was managed in a very tight range, either net long or net short. We managed the book very, very close. For most of the days in this month, we managed the book in the plus minus 7 or 8% net long or net short range. We touched plus 17, plus 18 once, but then we pulled it back. So now our book has gone to about 11% net long in the last 2 or 3 days of strong rally. But we've been moving the stock book very, very slowly. So our daily NAV or performance during the entire month, right till, if you see 2 days ago, barring the move that we've seen in the market today and yesterday to some extent, till about 15th of the month, the market was literally chopping around either 0.5% positive or 0.5% negative. And it started the month, as you can see in this table, 2 or 2.5% down. And there has just been chopping around. But in this whole chopping around, our NAV stayed in the positive territory. Our returns were very, very stable. So intra-month volatility of NAV moves, which happened in August or which happened in June, we completely avoided that risk in September. And we have been gradually adding on to our returns in the month of September. So at today's close, we are up and estimated, this could vary by 10-15 basis points up or down once we get the final numbers later in the night from our custodians. But at this point of time, it appears like the book is up 1.5% for September. And this whole addition has been gradual. So at the end of first week, we were up maybe 40 or 50 basis points. At the end of second week, last week we were up about 60 basis points. This week we have added onto those gains further, and we are up about 1.5%. And I think barring maybe one day in the interim, the NAV is never dipped into the negative territory this month. So we are managing the book very, very tightly at this point of time, and it's showing rewards. So since inception, now the return is about 15%, which for roughly 11 months and a week, or 11 months and 10 days that has passed, for us is a monthly return or monthly yield of about 1.3, 1.32%, or 1.35% approximately. To reach our target return of 17 to 18 or 17 to 19, we need to do close to 1.5. So we are on track, I would say. We are slightly behind, but not by much. And to cut a long story short on our performance, we negotiated the January to May volatility really well, because every time the markets dipped, we got some breathing space, we got a range. We could not anticipate or could not see that in June or August, the fall will start reversing from next day onwards. And that caused a little bit of distortion and pain. We have slightly shifted our style September onwards, and it's reaping rewards, and we are back on track. So with this, I know it's a little bit of a more detailed background on what happened last month, what changes we have done this month, what happened through this year. But I think it's important to put this in perspective that, I mean, once you look at it from a distance, it appears that June and August were very volatile months, and a long short fund should have done better in very volatile months. But if you zoom in, if you actually look at it closely, the entire volatility was restricted to just 1 or 2 days. And if you were lucky or smart not to move the book positioning very aggressively towards short side, one would have done better. But we did, and we did because of our learnings of how we were managing the book in Jan to May, which really worked for us. But it didn't work for us in June and August. So we shifted the strategy slightly, and it's working fine now. So we are back on track. So with this, I will just move on to how we are seeing the market. Sal, can you go to the next slide first? We'll come back to this at the end. Yeah. What sectors we like at this point, what we have been playing over the last 1, 2, 3 months, where are we making money, what's working and what's not. We can just go a little bit of deep dive into that. So for the last 3 months, since June, and this is the third or the fourth webinar that we are sort of reiterating very similar themes and sectors. So we wrote 3 newsletters, which we titled Winds of Change 1, 2, and 3, which was immediately following the election results. We said, going into elections, markets are very volatile, which is usually a sign of a trend change, either the trend change in the entire market or the trend change in the components of the market, as to which sectors start doing better versus the other. And we saw signs of some of the strong outperforming sectors in the market going into a correction phase, and the sectors which have been consolidating or correcting for the last 2 or 3 years going into an uptrend phase. We picked 3 sectors that we liked at that point of time: IT services, FMCG, and pharma. And we added the 4th in the recent past, which is private banks as well. Of these 4 sectors, 3 have a very, very common feature, that the last 2 or 3 years, they have been gross underperformers. So first one is IT. The chart on the left shows you constant currency QOQ growth. The chart on the right shows revival or the growth numbers coming out of North America, which is the largest market for IT services companies. Both are showing signs of uptick. And on America, a very, very important point. I mean, this debate on America keeps happening, whether US is going for soft landing or hard landing, and whether the economy is strong or weak. In our opinion, it is a soft landing scenario. In our opinion, the American economy is not as weak as sometimes the headlines make it out to be. And in fact, in the recently concluded quarterly season, outside of the, I mean, in US, everybody looks at Magnificent Seven and outside of Magnificent Seven. So ex Magnificent Seven, which is the balanced 493 companies in S&P 500, 80% or 75% of them beat analyst estimates. And the growth expectations by the analysts had to be almost doubled as compared to what it was pre-results. So analysts were earlier expecting the S&P 493 to grow only at 4 to 5% this year. That number has been now raised to 9%. And typically, we have seen historically that whenever earnings traction for S&P 500 picks, their ability or their willingness to spend more goes up, which obviously means more orders to Indian IT companies. So this is one space where we have made good amount of money in the last 3 months. We have reduced the exposure a little bit last few days, booking profits, but nevertheless, this is one sector which has done well. Next slide. So this is a little bit more on IT services, showing a little bit of sign of an uptick on the BFSI, which has been in a secular decline mode. And this is again the largest client segment for IT services. Utilization levels, which is the yellow dot on the right slide, is at a 5-6 quarter high, and it's been improving. So that's also a sign that the slack is now being completely used and an uptrend is on the corner. Next slide. So FMCG is one space. So the second space which we have been speaking about for the last 2 or 3 months, we continue to reiterate our confidence here. HUL has been a core position all this period. It's even now it's one of our largest position in the portfolio. And it's not just FMCG. We are talking about consumption in general. So FMCG, retailing, QSR, apparel, there is a uptake in demand traction across all these segments. Multiple reasons for that. Great monsoons this year, and the table on the left shows that the Southwest monsoon has a 92% correlation with FMCG demand. So many companies are already talking about a strong uptick in the rural demand, which is more important for FMCG companies. Many of the management commentaries, even in the low-ticket discretionary items, are talking about demands bottoming out and showing signs of a pickup. So in our current portfolio, we have HUL, Nestle, Jubilant FoodWorks, and Titan. Nestle is a recent addition. HUL has been doing really well for us, so it's Titan. And we are also playing sort of discretionary consumption through Bajaj Auto as well. Next slide, please. So this is not a new sector. I mean, pharma has been in a trend for now 1 or 2 years. There are a whole host of charts here. I won't go into each of them. But 2 or 3 key stories in pharma is that a large number of drugs, or the large pipeline of drugs, are going off patent in the US, which is a large opportunity for Indian pharmaceutical companies. There is, in general, a meaningful shortage of drugs in the US, which has pushed prices for the branded products very, very high. And as a result of which, the entire generic price decline in the US has now been arrested, which is fantastic for our margins. US recently signed the Biosecure Act, which is for increased sourcing of drugs and drug intermediates from other parts, and India is a big player out there. When there are initially most people are trying to play pharma through domestics, but we actually prefer pharmas which are more exposed to international, because that's where the biggest pickup is. We made good amount of returns on Lupin, book profits. We recently booked profits over the last 2 days of 20% plus. We are still holding DVs as one of our largest and core positions, which is a big beneficiary of the Biosecure Act as well. So Lupin has been a fantastic turnaround case. This is an illustration of that. Look at how the EBITDA margins has picked up, which is the yellow bar on the bottom chart. Look at how the EPS growth estimates have picked up, which is the yellow line on the top chart. Next slide, please. This is one space which has been have been the darlings of the markets over the last 4 years, 2020 to 24 early, and it just became far too expensive. And at the margin, there is little bit of a slowdown in the capex intensity in the country as government now is balancing its focus both on capex and consumption. And that was a message BJP took from the election results, that they have probably ignored the bottom of the pyramid and we need to refocus there. So government increased the revenue expenditure in the budget presented after the elections to a growth of almost 10%, 10, 11% round. Correct me if my number is wrong, or say percent.
Yeah.
Yeah. And a little bit of a slowdown in the new orders and the new capex. Meanwhile, the industrials were priced not just to perfection, but priced to high growth continuing. So the charts on the left are ABB valuations with respect to its own history and with respect to premium to Nifty, and the chart on the right is Siemens. We're showing them as illustrations. We made reasonable amount of profits in shorts on industrials, including defense, ABB and Siemens, largely playing on this fact that there is a cycle rotation towards consumption from capex. Valuations were far too high. And at the margin, the rate of change of consumption is superior to the rate of change in capex. We have started booking profits in some of those shorts now. I mean, these are end of their tactical shifts and may or may not persist for a very long period of time. One is cognizant of that. Most of the industrials are actually down approximately 20% from the recent peaks, top to bottom. It may fall more, it may not, but that is something that we'll watch closely. Another shift within our own universe, I mean, till pre-June, PSU banks used to buy favorite longs. In the last month or two, we've actually made reasonable amount of profits on PSU bank shorts. So PNB here is an illustration, but we've made money on shorts on PNB, Bank of Baroda, and a little bit on SBI as well. We currently have booked out of Bob and PNB, but we still have SBI short in our book. PNB, you can see the valuations reached almost 1.5 times with just about a 10% ROE. So at least from a near-term point of view, 1.5 times type valuation, which is probably just a shade lower than where HDFC Bank is, was a little bit out of whack. And in this whole cycle rotation, we made some money out of the PSU shorts as well. So now you can, Sahil, now you can go back to that sine curve chart, because it makes more sense to show that now. Yes. So this is what I touched upon at the beginning of the talk, that our stock picking framework is what we call sine curve. So sine curve, as the line represents, I mean, nothing is a straight line, everything is a cycle. I mean, that's the whole belief of sine curve. Whole life is a cycle. Politics, economy, business cycles, globalization to anti-globalization, fashion trends, everything is a cycle. So basically what we do here is that we divide our companies in our universe into companies where businesses are accelerating. That's the upward slope of the sine curve, which forms a long universe, and companies where businesses are decelerating, which is a downward slope of the chart, which forms a short universe. And then we use a little bit of a momentum analysis, a little bit of triggers, a little bit of short-term catalysts to pick and choose out of that universe which stocks will go into a long book and short book. And for acceleration and deceleration, we look at variables like earnings growth, ROE, ROC expansion or contraction, market share expansion or contraction, operating margins expansion or contraction. So bulk of the names that we currently have on our current portfolio, I mean, this chart is maybe 5 days old, so maybe a few names will have moved here and there, or a few we might have booked profits. So we have plotted it here. So as I said, pharmas, we are looking at very strong medium-term trend, and especially on the names that we put here. So DVs, Lupin, and Biocon. In BFSI, we are seeing a very strong traction Banking is a little bit more tactical, but some of the non-banking or non-lending financial services like insurance, like asset management, is a structural long-term trend. We currently don't own HDFC AMC, but we own Bajaj Finserv, and it's one of our largest positions. IT, I've talked about. We are seeing an uptrend. We are seeing early stages of revival. Discretionary Titan and Bajaj Auto, I talked about. It's there in our portfolio. Indigo, we book profits. We continue to have Chola at this point, although I must admit that at the current valuations, Chola seems to be more like close to the top of the curve, and we'll be watching very closely when to book profits. It's done well for us. Industrials, again, we have talked about that we are seeing a little bit of a slowdown, a little bit of a valuation correction, so it's on the downward slope of the curve. Same with the PSU banks. If you focus on the right side of the curve, here is where most of the consumer names which have been beaten down in the last 2 or 3 years figure. Early signs of an uptrend. If these early signs of an uptrend actually become strong, it could actually translate into not just a tactical call, but it could translate this into being a 2 to 3 years kind of an uptrend cycle call. So we'll wait for more confirmation there to see whether these early signs of turnaround becomes a full-blown high growth phase or not. And the names there are Page and Jubilant. We own Jubilant. We don't own Page. We own HUL. We had ITC. We booked profits there. And you have Nestle. The name is a new addition, so it's not there on this chart. So this is an illustration of how we think. This is an illustration of how we analyze our companies. This is an illustration of how we create a long and short universe. And then from this, we pick our stocks and names. So ladies and gentlemen, thank you. I mean, that's all from my side. Thank you for very, very patient listening. We can now open for Q&A. So strategy and investment framework side, I think I touched upon in the various parts of the presentation and also right at the beginning. So we can skip that for now.